For decades the European Union has been a vehicle for peace and prosperity. But today, can we really say the same about this union of European nations? Well, it appears that it is now incapable of delivering the peace and prosperity that it has always promised. Rising inflation, decline of the euro as a currency, and the war in Europe have jolted the continent. Even though the European Union as a whole is the second largest in terms of economy, it is still tearing apart from the inside. So, what has happened to the Europe? And where it is headed now? To understand this, we have to look into a few things. You see, in the long run, European Union is one of the most distinctive political creations of the late 20th century. After a half-century marked by economic depression and 2 world wars, the 1957 Treaty of Rome established the basis for one of the longest periods of peace and prosperity the European continent has ever known. The introduction of a unified currency, the euro, in 1999, brought participating European countries closer together through the convenience of a shared currency, resulting in a stronger European cash flow. Today, after the US dollar, euro is the second largest reserve currency and the second most traded currency. This union of nations is also the world's third largest economy in nominal terms, after the United States and China, and also in purchasing power parity terms. However, despite being one of the largest economies in the world, the EU appears to be breaking down in recent years, with economic growth and recent events such as the pandemic, and the Ukraine-Russia conflict exacerbating the situation. Now we have to understand, Europe's economic slowdown is not just because of the pandemic and recent energy crisis due to the Ukraine conflict. It actually started in 2009, known as the European debt crisis. The debt crisis began in 2008 with the failure of Iceland's banking system, and it quickly spread to Portugal, Italy, Ireland, Greece, and Spain. The Eurozone crisis resulted from the structural problems and a combination of complex factors. It was caused by a balance of payments crisis, which is defined as a sudden stoppage of foreign capital into countries with large deficits, and reliance on foreign lending. The crisis was worsened by states' inability to devalue their currencies. Also, the 2007-08 financial crisis was one of the contributing factors. By the end of 2009, Greece, Spain, Ireland, Portugal, and Cyprus were unable to repay or refinance their government debt, or bail out their troubled banks without the assistance of third-party financial institutions. With increasing fear of excessive sovereign debt, lenders demanded higher interest rates from Eurozone states in 2010, with high debt and deficit levels making it harder for these countries to finance their budget deficits, when they were already faced with overall less economic growth. Several of these countries, including Greece, Portugal, and Ireland, saw their sovereign debt downgraded to junk status by international credit rating agencies during the crisis, exacerbating investor concerns. To combat the crisis, some affected countries raised taxes and cut spending, contributing to social unrest and a crisis of confidence in leadership. Ultimately, with the help of third-party intervention like the European Central Bank, the IMF, and EFSF, EU got out of its slump, but it did not fully recover. Economic growth of the EU as a whole after 2009 was very slow. And then came the pandemic. In March 2020, Italy became the epicenter of the coronavirus pandemic, and free movement of people, which is one of the EU's founding principles, was suspended across the continent. During this time, unemployment rates soared, and the EU economy contracted by more than 6%. And just as the immediate threat of the pandemic was fading, the greatest threat to European security since the Cold War was taking shape on Ukraine's borders. The conflict in Ukraine threatens to derail Europe's economic recovery. Nearly 7 million Ukrainians have fled the country. The conflict and subsequent sanctions have disrupted regional exports of commodities such as metals, food, oil, and gas, driving inflation to levels not seen in decades. The European Union's real economic growth is now expected to fall from 3% in 2022 to 0.5% in 2023. You see, Ukraine and Russia are important suppliers of energy and agricultural products. As fighting damages of production facilities, the prices of many core products will continue to rise, particularly those that are difficult to substitute, like wheat, fertilizers, and gas. Inflation in the European Union was 10.4% in December. This is down from 11.1% in November and 11.5% in October. Higher oil prices is the major reason behind this high inflation rate. 10 European Union countries rely heavily on Russia for oil and gas imports. Russia accounts for more than half of these countries' gas and oil imports from outside the European Union. Due to sanctions imposed by EU on Russian oil and subsequent damage on Nord Stream 1 gas pipeline, EU is struggling to get its hand on crude oil. Some of the region's businesses have also threatened to close their doors if oil prices remain high. Even though the EU has secured their energy needs for this winter, they will suffer next year if things didn't improve. Well, these are some short-term problems the EU is facing. Perhaps the biggest threat to the EU in the coming years is the declining population. According to Eurostat, the EU's statistical agency, the population in the European Union is projected to decline by around 3 million between 2020 and 2070. The aging population is also a major concern, as the proportion of people aged 65 and over is projected to rise from 18% in 2020 to 30% in 2070. This demographic shift is expected to have a significant impact on the EU's economy, as it will lead to a decrease in the number of working-age people, and an increase in the number of retirees. This creates a risk of a decrease in economic growth, and an increase in the cost of healthcare and pensions. An aging population also means that there will be fewer people paying into the pension system and more people receiving benefits, which could put a strain on the finances of the pension system. This could lead to higher taxes and lower benefits for future generations. The decline in population also has an impact on the labor market. With fewer people of working age, it could lead to a shortage of workers and higher wages, which could increase the cost of goods and services. This could also make it more difficult for businesses to find the workers they need, which could lead to slower economic growth. So, after looking at the past, present, and future, it appears that the EU lacks a unified voice to address these challenges, as many of the partner countries have their own agendas. Brexit is a good example of how the EU is not as effective as it should be. Brexit was a significant event in European history, and other members may follow this example if the EU fails to deliver on its promises of economic growth and prosperity. Now, what are your opinions on this video? Please tell us in the comments. And if you are new to this channel, please consider subscribing. Thank you.